Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to review how a company becomes a stock. When a company becomes a stock, they want to increase their capital. There are only two ways that companies can increase their capital. They could borrow the money through the issuance of a bank loan, a bond sale, or something of that nature, or they can sell off a percentage amount of their firm. When a company decides they want to sell a percentage of their company, they can do so to the general public. In order to do that, they must go through the underwriting process. To underwrite a security is to assume the risk of buying a newly issued security from a company and then reselling them to investors. So, investment banks will go in and give a set amount of money for a certain percentage of a particular company and sells it to investors. The investment banks receive compensation from that. The compensation that investment banks receive from that is known as the underwriting spread or the underwriter spread. The underwriter spread is simply the compensation to the underwriter, which is determined by the difference between the underwriter's buying price and the offering price. When an issuance is so big, oftentimes groups of banks will come together. A group of investors that form together to share the risk of purchasing this new issue is called a syndicate. To continue, there are several different kinds of underwriting. A firm commitment underwriting is when a firm buys the entire percentage amount. If they are not able to sell the entire percentage, the full financial responsibility falls back on that investment bank. There's also what's known as best efforts underwriting. This is where an underwriter sells as much of the new issue as they possibly can, and then they return any unsold shares to the issuer without any financial responsibility to the company. A Dutch auction underwriting is a type of underwriting in which the offer price is based on competitive bidding by investors. This is an example of a Dutch auction. The price of a security is listed here. The bids are here. When a company, for example, decides that they would like to sell 5 million shares, these 6 bids would receive those shares because its total share price is here. The price that all 6 of those bids would receive is 35. If the company, for example, wanted to sell 10 million shares, they could do so here at this price, and all of these bids would receive the same $34 price. The primary market is where all of this happens. Once investors have their securities, they can then buy and resell those securities. This happens on the secondary market. The secondary market is a market in which previously issued shares of securities get traded among these investors. The third market is an off-exchange market for securities listed on an organized exchange. An example of this could be the OTCBB. The fourth market is a private market in which securities are sold among investors. It is a market for exchange-listed securities in which the investor trades directly. Again, this is Blaine Pearson, and in this video, we covered how a company becomes a stock. Thank you for watching.